In this explainer, we are breaking down every major asset class. No jargon, no fluff, just clear, direct explanations of what they are and how they can actually work for you. I mean, if you've ever Googled how to start investing, you've probably felt like you were drowning in alphabet soup, right? Words like bonds, REITs, commodities, equities, people throw them around like we're all just born knowing what they mean. It's completely understandable if you've ever wanted to just close the tab and walk away. I have absolutely been there. But stick with me today because I promise you a straightforward, fluff-free look at exactly where you can put your money to work. All right, let's dive into this by establishing our core framework. I really don't want you stressing over complex financial terminology. Instead, I want you to simply think of these asset classes as different buckets. Literally, just buckets. Each bucket holds a very distinct type of investment, and the fascinating thing is that each bucket behaves entirely differently depending on what's happening out there in the broader economy. The whole game of investing? It's essentially just figuring out how much of your money goes into which bucket. This is called asset allocation, and it is arguably the most important decision you're ever going to make. Here is our roadmap for today. We're going to climb up the ladder of risk through 4 main buckets: fixed income, equities, real estate, and commodities. Then we'll bring it all together for the big comparison.
Okay, let's start with bucket number 1, fixed income, or, as I like to think of it, getting paid to lend your money out.
When you buy a bond, you are essentially acting as the bank. You are lending your money out to someone else. Now, what's really interesting here is the contrast between who you can actually lend to. First up, you've got government bonds. You can lend $1,000 to the US Treasury, for example, and they promise to pay you back in a set number of years plus interest. Because the US Treasury is considered literally the safest asset on earth, they have never defaulted, your risk is incredibly low. On the flip side, we have corporate bonds. You can lend your money to a massive corporation like Apple or Toyota. But since companies can and do go bankrupt, and governments rarely do, corporations have to offer you a slightly higher yield just to compensate you for taking on that extra risk of default.
So what do you actually get in return for that incredible, ironclad safety of a government bond? Well, historically, those ultra-safe government bonds have returned around 2 to 3% annually in real terms. That means this is your return after inflation has taken its cut. Look, I know it isn't the most exciting number in the world, but the absolute keyword here is safety. Now, if you're willing to take on just a bit more risk by lending to those solid companies through investment-grade corporate bonds, historical returns dump up a bit to about 4 to 5% annually. If you go for even riskier companies, what they call junk bonds, you might see 6 to 8%, but with a very real chance they might not pay you back at all. Ultimately, bonds give investors, particularly retirees, the absolute predictability they love. You're for sure not going to 10x your money, but you know exactly what you are getting.
Moving right up the risk ladder brings us to our second bucket, equities. This is where you actually own a piece of the pie.
This is where things get really dynamic. Here, you are no longer the bank. You aren't lending money anymore. Instead, you're actually buying ownership, a tiny, microscopic slice of a real, living, breathing company. If the company crushes it, you crush it. But unlike bonds, stocks have absolutely zero guaranteed return, none. But history has shown us that taking on that volatility is usually rewarded. The S&P 500, which tracks the 500 largest US companies, has historically rewarded investors with an enormous average return of roughly 10% annually over the last century. That's about 7% after inflation. That is a massive jump from bonds. But remember, that 10% is just an average. In any given year, the market could rocket up 30% or completely tank 40%. The price you pay for that high long-term return is simply weathering that short-term roller coaster.
And here's a somewhat uncomfortable truth. Most highly paid professional fund managers actually fail to beat the S&P 500 over a 10-year stretch. So why would a beginner try to pick individual winning stocks? Actually, scratch that. They shouldn't. Beginners are way better off just buying the whole market at once through low-cost index funds or ETFs. You instantly get a slice of all 500 top companies, and you avoid bleeding hundreds of thousands of dollars in management fees over your lifetime. It's a total no-brainer.
All right, let's transition to bucket number 3, real estate, the ultimate tangible asset. Real estate is an asset class that pretty much everyone thinks they understand right out of the gate. Mostly because it's physical. You can walk into it, you can touch the walls. But direct real estate is totally a double-edged sword. Yes, it's a tangible asset that beautifully holds its value during inflationary periods. And yes, you can use leverage, meaning you use a bank's money via a mortgage to supercharge your own returns. But the trade-off is severe illiquidity.
I mean, you literally cannot sell your guest bathroom when you suddenly need some quick cash. Add in those massive upfront down payments and the endless joy of managing tenants and fixing leaky roofs at midnight, and yeah, it is a serious commitment.
But what do the numbers look like? Well, U.S. residential real estate historically appreciates around 3 to 4% annually, which basically just keeps pace with inflation. But when you factor in that modest appreciation and you stack the rental income you collect from tenants right on top of it, direct real estate historically delivers a really solid 7 to 10% annual return on well-managed properties.
But what if you don't happen to have an extra 100 grand lying around for a down payment? Well, that brings us to a brilliant workaround: REITs, or real estate investment trusts. These are companies that own massive income-producing properties. Think shopping malls, office buildings, or even hospitals. They trade right on the stock market, meaning you can jump in and invest with as little as $50. And the best part? By law, they are actually required to distribute at least 90% of their taxable income right back to you, the shareholder, as dividends.
Because of those mandatory high-yield dividends combined with the natural price appreciation of the real estate they hold, REITs have historically yielded a super impressive 8 to 12% annually over long periods. It's basically a cheat code to get the financial benefits of real estate without ever having to unclog a toilet.
Which brings us to our final bucket, number 4, commodities, the raw materials.
Now we are stepping completely away from companies in real estate, and we're looking at the fundamental raw materials that quite literally keep the world running. Think about the big ones: oil, gold, wheat, copper, even coffee. But this brilliantly illustrates the big catch with commodities. A barrel of oil sitting in a warehouse doesn't pay you a dividend. A bar of gold doesn't generate income or send you a monthly check in the mail. Unlike stocks or bonds, you only profit from commodities if the raw price of the material actually goes up before you decide to sell it.
So, you're probably asking, if they don't generate income, why do we even bother with them? We bother because they are an incredible hedge. When inflation spikes, the prices of these raw materials naturally rise right alongside it. Gold, for instance, has been a reliable store of value for thousands of years. More importantly, they provide absolutely vital portfolio diversification because they often move completely independent of the stock market. Check this out. When the stock market crashed horribly back in 2008, gold actually went up. It acts as a shield, protecting your overall wealth. That being said, because they don't produce passive income, commodities as an asset class have historically returned only about 2 to 3% annually in real terms. So no, they aren't the primary strategy you'd use for massive long-term wealth building. Think of them more like an insurance policy. They're for protection when your other investments spring a leak.
All right, section 5, the big comparison. Let's look at risk versus return.
We have officially explored all 4 rooms of the investing house, so let's synthesize all this data and see how it builds into one unifying law. Take a look at this matrix. This is your ultimate cheat sheet. You can see exactly how risk, return, and liquidity all interact across every bucket we discussed today. Notice the absolute safety of government bonds compared to the high return but high risk of the S&P 500. You can also clearly see the great historical returns of direct real estate being weighed down by its very low liquidity when you compare it to highly liquid stocks and bonds.
The pattern you're seeing across this table reveals the absolute fundamental law of investing, the risk-reward trade-off. It's an unbreakable rule. To achieve higher long-term growth, you absolutely must accept higher short-term volatility and risk. There is simply no free lunch in the financial markets.
You gotta always remember this golden rule. If you see an ad on the internet or someone pitches you a guaranteed 20% return with zero risk, they are lying to you. Run away. Because the true magic of investing isn't about trying to pick the single best asset or finding a secret loophole. The real magic is intelligently spreading your money across these different buckets so that when one takes a hit, the others hold you up. They balance each other out for a smooth, stable, long-term climb.
Now that you understand the actual mechanics behind these 4 distinct asset classes, fixed income, equities, real estate, and commodities, all that financial jargon shouldn't scare you anymore. The power is entirely in your hands to allocate your buckets and build a stable, prosperous financial future. Keep in mind, historical returns never guarantee future results, but arming yourself with this foundational knowledge is hands down the greatest investment you can possibly make. So, how are you going to allocate your buckets? Thank you so much for joining me on this explainer, and I really hope this empowers you to take that next step with confidence.